Hey, welcome to today's video. In today's video, we're going to talk about stock market volatility, what exactly it is, how to put it in perspective, and if you're in the market, really not be concerned about it. It's just a natural occurrence of being an investor. Guys, welcome to my channel. My name is Howie Lim. I'm based in San Francisco, California, and Tokyo, where I talk about everything related to finance, professional development, and business. So if you'd like to hear about that kind of stuff, don't forget to click and subscribe. Let's get right into the video. So market swings are kind of like a natural occurrence in the market, and it's not untypical to see anywhere from 15 to 20% market swings for a given year. And be prepared that every 1 in every 5 years, you can expect to see an even greater 30% upward or downward fluctuation in the price of the market. And what is that exactly? And is that something to be concerned about? So for demonstration purpose, what I'm going to do today is I'm going to go over the price of Microsoft stock for a given year, just to put it into perspective and just give you an idea of how it exactly works. So we're using the price point of July 28th, 2023. Microsoft had a stock price of $342.83. And over the course of the year, October 3rd, 2023, it went down to around $313.39, and then finally ended the year at $425.27. So that is a kind of a varied fluctuation in the stock price, but it is an upward trend, which generally kind of characterizes the movement of the stock price and the market. So the total return, or the yearly rate of return, is a simple formula that you can calculate to see what your return on an asset is. So given the price that I just provided for you, the beginning price and the ending price, we take the ending price of $425.27, subtract it from $342.83, and then divide that by the beginning price, which is $342.83, and multiply that by 100 to get a percentage, and it's 24%. Now that's pretty good, a 24% return on your investment. Let's say you put $5,000, or you had a holding of $5,000 of Microsoft stock at that beginning date of July 28th, 2023. Within the course of a year, 24% return, you would have made $1,200 on that $5,000 by just letting it sit there, not touching it, not moving it, not selling it, just letting it sit there. It's a pretty good rate of return, considering that most CDs or money market funds are returning on average 5%, which you're getting a lot less of your money versus the stock. Now, another thing to consider is the indexes. When they're talking about, you see it hyped up on the news like CNBC or Yahoo Finance or one of these news channels or outlets, that the Dow is up or down. Dow drops 200 points, or Dow drops 400 points, or goes up 400 points. Now the Dow Jones Industrial is a makeup of the 30 largest companies in the US, and their market capitalizations are huge. So any kind of 100, 200, 300, 400 movements in the market are very much negligible, and you shouldn't be concerned about that, because that is on average a half a percentage point to 1% movement in the market, just to put it into perspective. So let's get down into what actually causes market volatility. Market volatility has very good root causes and explanations for the movements, but they also have kind of weird or things that don't necessarily make sense into why this particular index moved up or moved down. So some kind of fundamental or obvious explanations to be why the index would move up or down is obviously the Fed may cut interest rates, the Fed may raise interest rates, the jobless claims, how are we in a recession, geopolitical concerns, national security, presidential elections, with the upcoming elections with Donald Trump and Kamala Harris. That certainly is going to put that into effect. The 2024 Olympics, even something like, the color of the underwear of the France starting ceremonies was not in favor with a lot of religious organizations, and stuff like that's going to move the stock market. And finally, some more serious stuff like foreign policy and Gaza. All these things have effects on the market. Now, some of them can have good effects, some of them can have bad effects, but overall, if you take the average, it's not that great. But let's take a little kind of more introspective into this, like what happened with 2022 and the coronavirus. Now, that hit us hard, and that hit the global economy hard, and that did have a profound and great impact on the stock market. So let me just take this into historical perspective. On Monday, March 9th, we started the whole corona thing 2020. On Monday, March 9th, the Dow Jones fell 2,014 points. That's significant, almost 8% drop. March 12th, dropped another 2,352 points. And finally, on March 16th, it took another nosedive at 3,000 points. Now, you would think with all these doom and gloom, overall the 30% drop, and that a lot of people were concerned about, very concerned about their retirement savings. Some sell off, and people were concerned, why should I be in the stock market? It's not going to recover. The economy's not going to recover. Interestingly enough, as we watched the coronavirus wreak havoc on the global economy and our personal lives, something happened in April that kind of turned that around. And those were mainly economic factors and government intervention, with basically the Fed cutting the interest rates to zero and there being a huge financial stimulus package of over $2.3 trillion, which helped a lot of small businesses. You remember the types of loans that were going out to sustain businesses that were hurt, because a lot of them were hurt and the market and people were seriously suffering, and it was not a good time. But with everything that happened in 2020, at the end of the year, stock market still grew. Can you believe that? Yeah, the stock market still grew, and the Dow Jones gained roughly 6.5%, the S&P gained 15.6%, and the Dow Jones gained an astonishing 43.7%. That is huge. What can we take and what can we learn from market volatility in general? That market fluctuations going up and down are just a part of life. And if you take a look at the inception of the stock markets to where the US stock markets to where we are today, you can just see it trending. We had several, the Great Depression, we had the 1987, the Black Monday crash, and then 2008, we had a huge Great Recession, and those are all negatively affected. And those are negative, but we also had very positive where the markets have bolstered and rallied about, and the valuations in the stock market have just gone through the roof. And so if you're in the market for the long haul, let me just stress that you will win in the end, because historically, stock market has returned greater percentage return for investors, more so than bonds, gold, or other assets. Now, my personal recommendation is if you're just starting out investment, you want to invest in broad market indexes, so you're not investing in one particular stock. Three that come to my mind that have given good returns, 15 to 20%, and have a good diversification of different stocks and different sectors include the Fidelity Zero Large Cap Index, FNILX, QQQ, which is Invesco's ETF, very tech and growth companies are in there. They've done outstandingly well, QQQ. And finally, we all know about Vanguard's S&P 500 ETF, VOO. If you like this kind of content, don't forget to click and subscribe, ring the bell. I also have a link down to my Beacons page. You can subscribe to my newsletter where I give weekly information on what's happening in the market, personal business, as well as some very good and helpful tips that will help you if you're in an individual, small business, or regular business. Thanks a lot for joining today's video. I'll talk to you soon. Take care now.